These cause real short-term volatility. The market lurches, the headlines scream panic, your portfolio swings wildly. It honestly feels like the sky is falling. But here's the calming truth. Geopolitical shocks rarely change the long-term fundamentals of good companies. Markets wobble, then they recover. The businesses keep selling products, earning profits, and growing. The panic fades, the value remains. So now you understand the news. Here's the part that actually protects your money. Don't trade on it. Knowing how rates and inflation work doesn't mean you can profit by jumping in and out on every headline. Why not? Because you're racing professionals with supercomputers who already reacted in milliseconds. By the time the headline reaches your phone, the price has fully adjusted. You're not early, you're late, every single time, by design. And the bigger cost is emotional. Reacting to scary news is one of the biggest return killers there is. You sell in fear at the bottom, then buy back in greed at the top. Buy high, sell low, repeat. There's even a name for this gap, the behavior gap. Studies of investor behavior have repeatedly found that the average investor earns less than the very funds they own, simply because they jump in and out at the worst times. So, what should you actually do this week? First, keep dollar cost averaging. That just means investing a fixed amount on a regular schedule, no matter what the headlines say. Same amount, same day, rain or shine. Why does that work so well? When prices drop, your fixed amount buys more shares. When prices rise, it buys fewer. You automatically buy more when it's cheap. No prediction, no panic, no perfect timing required, just discipline. Second, stay diversified. Don't bet everything on one stock or one sector. Spread across many companies, ideally with a low-cost index fund that holds the whole market. When one zigs, another zags. The shocks hurt less. Third, tune out the daily noise. Turn off the breathless alerts. Check your portfolio less, not more. The financial news exists to keep you watching ads, not to make you rich. Their urgency is not your strategy. Fourth, write down your plan while you're calm. How much you invest, in what, how often. Then when scary headlines hit, you follow the plan instead of your panic. A written plan beats a racing heart every time. Let me give you permission to relax. You do not need to understand every wiggle in the market to build real wealth. The boring, patient investor who ignores the noise usually beats the frantic one glued to the screen. The headlines want your fear because fear sells. But your wealth is built in the quiet years of just staying invested. Time in the market beats timing the market. Almost nobody times it right, twice, consistently. Quick recap. Markets are forward-looking. They move on the surprise, not the raw number. So the news you read is usually already in the price before you even finish the sentence. That's lesson 1. Burn it in. Lesson 2. Rates are the master lever. Hikes pressure stocks and push bond prices down. Cuts do the opposite. Hot inflation means hikes, and good economic news can be read as bad all through that rates lens. Lesson 3. Understand the news, but don't trade on it. Keep dollar cost averaging, stay diversified, tune out the noise, and follow your written plan. Calm, boring, and consistent is the strategy that quietly builds real wealth. Now I want to hear from you. What economic headline scares you the most right now? Rates, inflation, or a jobs report? Drop it in the comments and let's talk through it together. I read every single one. And if this made the noise feel a little less scary, do me a favor. Hit like so more nervous investors find it. Subscribe for one simple money lesson at a time. And share it with a friend who panic checks their portfolio. Every day the headlines scream at you. Rates are rising, inflation is hot, jobs are booming. Your stomach drops, your finger hovers over the sell button. Stop. That panic is exactly what wrecks your returns. Here's the truth almost nobody tells you. Understanding economic news is smart. Trading on it is usually dumb. By the time you read a headline, the market already moved. You're reacting to old news, and that's a losing game. So today you'll learn what the big reports actually mean. Rates, inflation, jobs, earnings. You'll see how they push stocks and bonds around, and you'll learn why staying calm beats trading on every one of them. First, the single most important idea of all. Markets are forward-looking. The price of a stock today already reflects what investors expect to happen tomorrow. Prices aren't really about the present. They're a bet on the future. That changes everything. Markets don't move on the number itself. They move on the surprise. That's the gap between what actually happened and what everyone already guessed. Beat the guess, and prices jump. Miss it, and prices fall. This is why a great report can crash a stock. If everyone expected great and got great, there's no surprise left. The good news was already baked in. The number was fine. The expectation was the problem. Keep that in your back pocket. Whenever you feel the urge to trade a headline, ask one question. Did this actually surprise the market? Usually it didn't. And usually you already missed the move anyway. Now the biggest lever of all, interest rates set by the Federal Reserve, America's central bank. Think of rates as the price of borrowing money. When that price changes, it ripples through every single investment you own, big and small. When the Fed raises rates, borrowing gets more expensive. Companies slow down, loans cost more, people spend less. The economy cools off on purpose. That pressure tends to drag stock prices lower, especially fast-growing tech names. Why do growth and tech stocks get hit the hardest? Their value lives in future profits, years and years away. Higher rates make those far-off dollars worth less today. So the shiniest growth names often fall the furthest. When the Fed cuts rates, the opposite happens. Borrowing gets cheap. Companies expand, people spend more, the economy speeds up. Cheaper money usually lifts stock prices. That's why investors cheer and rally whenever rate cuts are coming down the road. Rates also rule the bond market, and here's the trick that confuses everyone. Bond prices and interest rates move in opposite directions. Rates up, bond prices down. Rates down, bond prices up. Always a seesaw. Picture it simply. You own a bond paying 3%. Then new bonds start paying 5%. Nobody wants your old, stingy bond. So to sell it, you have to drop the price. That's the seesaw. So the Fed isn't just background noise. It's the gravity behind stocks and bonds at the same time. That's why every word from the Fed gets analyzed to death. But you don't have to play that game. Next up, inflation. That just means prices rising over time. The quiet danger? Inflation eats the real value of your money and your returns. A 5% gain means little if prices also rose 5%. Here's how inflation hits the market. When inflation runs hot, the Fed usually fights it by raising rates. And you just learned what that does. Pressure on stocks, pressure on bonds. Hot inflation often means short-term pain. Flip it around. When inflation cools down, markets usually breathe a sigh of relief. Cooler prices mean the Fed can ease off the rate hikes, maybe even cut. That's why a soft inflation report can spark a rally. Now, jobs and the broader economy, measured by reports like the monthly jobs number and GDP, the total output of the country. Strong growth means companies earn more, and earnings are what stocks ultimately follow. But here's the weird twist that trips people up. Sometimes good news is treated as bad news. If the economy runs too hot, that fuels inflation, which means higher rates. Suddenly, a strong jobs report scares the market, and the reverse happens too. Weak jobs data can lift stocks because it signals the Fed might cut rates to help. Upside down, right? That's the rates lens. Everything bends around what the Fed will do next. Don't forget the most direct driver of all, earnings, the actual profits companies report every quarter. Over the long run, stocks follow profits, plain and simple. A great quarter lifts a stock. A miss can crush it. Earnings season, when most big companies report within a few weeks, can swing individual stocks hard. But remember the surprise rule. It's not the profit number that moves the stock. It's the profit versus what analysts expected. Then there are the shocks. Wars, elections, crises, surprise events nobody saw coming.